In today's crazy fast markets, it's so easy to feel completely lost, right? But what if I told you the key to navigating all this chaos wasn't some new complex algorithm, but a set of principles from over 100 years ago? Yeah, let's dive in and see what the guy who literally invented the Dow Jones Index can still teach us about the psychology of a trend.
All right, first things first. We have to talk about the one thing that every single trader, I don't care if you're a total newbie or a seasoned pro, battles every single day. And that's emotion. It's this invisible force that can just completely wreck even the most brilliant strategy.
And that emotion, it leads to this classic and, let's be honest, painful question. Why on earth do we buy high and sell low? I mean, it goes against all logic, but we've all been there, right? Buying into the hype right at the top and then panic selling at the absolute bottom. It's something we all go through, and man, is it frustrating.
This quote it absolutely nails it. People sell early while the price is rising, and then they buy in a total panic while it's falling. We're reacting to our emotions, not the chart. And what happens? We lose. It's that simple. We react, we don't analyze, we feel, we don't see. And that gut feeling, that emotional knee-jerk reaction, that's almost always the thing that leads to losses. And you gotta understand, this isn't a new problem, it's a human problem.
So here's how we're going to break this all down. We'll start with that emotional trap we all fall into. Then we'll meet the guy who first figured this out, Charles Dow. We'll get into his 6 core principles, see how they still apply today, and finally, show you how to turn all this into a timeless compass for your own trading.
So who was this guy, Charles Dow? Well, yeah, he founded the Wall Street Journal and created the Dow Jones Index we all know. But his real genius wasn't just about crunching numbers. Nope. It was about understanding the one thing that drives all of it: people.
And this is maybe the most important thing to get about him. He wasn't a trader. He was an observer. He stood on the sidelines, outside of all the chaos. He didn't have his own money on the line, clouding his judgment. He just watched. And that gave him this incredibly clear, objective view of what was really moving the market.
And this is the big idea he came up with. For him, a chart wasn't just a bunch of numbers. It was a real-time graph of the crowd's hope, its fear, and its greed. Think about that. Every peak on that chart was a moment of mass euphoria. Every dip was a moment of collective panic. Price, he figured, was just psychology, made visible.
Okay, so from all these observations, he developed a whole system of thought that we now call Dow Theory. Fun fact, he never actually wrote a book. These principles were pulled together from his newspaper columns, but they became the absolute foundation for all modern technical analysis. So let's get into his 6 pillars.
So here they are, the 6 foundation stones of his theory. 1. The market discounts everything. 2. There are 3 trends in the market. 3. The major trend has 3 phases. 4. Different market segments have to confirm each other. 5. Volume confirms the trend. And 6. A trend is a trend until it's broken. Now they're all important for sure, but we're going to focus on the ones that give us the biggest psychological edge.
All right, pillar number 1. The market discounts everything. What does that mean? It means by the time you read that big headline, that information is probably already baked right into the price. The price isn't reacting to the news you're reading. It's the result of all news, all hope, all fear, all expectation, all mashed together. The chart is telling you what the crowd is thinking right now.
Next up, the 3 market trends. Now this is so interesting because it's like a roadmap for a trader's sanity. Dow saw 3 things happening at once. You've got the minor trend, that's just the daily noise that totally fools you. Then you have the secondary trend. These are the corrections, the pullbacks that are designed to sabotage your confidence. But the major trend, that's the big, overarching story. And that's the one that makes you rich, but only if you can tune out the other 2 and hold on.
And every single one of these major trends follows this predictable emotional story. It always starts with the accumulation phase. This is when the smart money is buying quietly. And honestly, most people just aren't interested. Then, boom, public participation. The trend is obvious, it's all over social media, and now everyone wants in. And finally, you get the distribution phase. This is when you hear people saying, "This time is different." And that's exactly when the pros are quietly selling their positions to that euphoric crowd.
And that brings us to the golden rule, the one that probably cost traders more money than any other mistake, trying to predict the top or bottom. Dow was crystal clear on this. A trend is in full force until you see definitive proof that it has reversed. And a single scary drop isn't proof. A bad headline isn't proof. The only thing that counts is a clear structural break in the market.
So, okay, these ideas were obviously game-changing back in the age of stock tickers and telegrams. But the real question is, do they still hold up today in our world of crypto and high-frequency algorithms? And the answer is absolutely yes. The game is exactly the same, even if the players and the speed have changed dramatically.
Think about it. Back then, Dow had really simple tools: price, volume, and just his own sharp eye for people's behavior. Today, we have this whole arsenal of complex data, right? We've got composite volume, open interest, liquidity data, funding rates, all this stuff. But here's the kicker. All these sophisticated tools, they're just new ways of measuring the exact same thing.
Exactly. The game is the same. The tools are just sharper. We're still just trying to measure human behavior. Hope, fear, greed, panic. Nothing about that has changed. Not one bit. Our tools for seeing it have just gotten incredibly precise.
And here's a perfect example. Just look at Bitcoin in the periods before its halvings. The price action gets quiet, social media gets bored, and a lot of traders start calling it weak or dead. But Dow, he would have recognized this pattern instantly. He'd call it the accumulation phase, that quiet, boring period where the smart money is getting into position long before the public has any idea a new trend is about to kick off.
Or how about this classic trap you see in markets like Ethereum all the time? You get a sudden price spike, but it's on pretty low volume, and suddenly the headlines are screaming, "ETH is flying!" It looks like the start of something huge, but Dow would have called this deceptive exuberance. It's a trap, plain and simple. It's a move designed to suck in emotional traders because it doesn't have the real broad participation or the structural change you need for a genuine trend.
So what's the big takeaway from all this? Well, it's that by really understanding these deep-seated psychological patterns, you can build a framework, a kind of mental model that helps you see the market with the same clarity that Dow had.
You know, in a way, Dow wrote the original language of market behavior. He figured out the grammar, the narrative structure of how trends live and die. Everything we do today with our fancy quantitative tools, we're just quantifying what he first saw with his own eyes. We've just translated his language into data.
This quote really sums up this whole philosophy perfectly. The market is never wrong, only you are early or late. It's so true. Arguing with the trend is like arguing with gravity. You're going to lose. The market is what it is. Our job isn't to fight it or to outsmart it. It's just to understand it and align ourselves with it.
And that really leaves us with one final and I think crucial question you have to ask yourself. When you look at a chart, are you really reading the market? Are you seeing the collective psychology? Or are you just seeing a reflection of your own hopes and your own fears? Because understanding that difference, well, that's everything. That's what separates real trading from just reacting.
Thank you for watching our video. In the next episode, we will examine the journey of another legendary trader. Don't forget to subscribe and turn on notifications. For more content and strategies, you can join our Telegram channel. The link is in the description. Stay well.